right, in Chapter 7, we're going to talk about some of the tax credits the IRS gives us. Now remember, a tax credit is a dollar-for-dollar reduction of your tax bill. If you owe $500 in taxes and you have a $500 tax credit, you're going to owe $0 in taxes because it is a dollar-for-dollar reduction of your tax liability. So let's look at a few of the tax credits we're given. Okay, so a tax credit or tax deduction. As we've talked several times, the tax credit is better because it's a dollar-for-dollar reduction of your tax liability, while a tax deduction only reduces your taxable income, and therefore it's only going to save your tax rate in taxes. So a $500 tax credit will result in a $500 reduction in a tax due. Again, dollar for dollar, $500 tax credit reduces your tax bill $500. A tax deduction will result in about a 75% tax savings, assuming you're in the 15% tax bracket. So if you have a $500 tax deduction, you'll save about $75 in your taxes. A credit has the same value to all your taxpayers. So again, when it's a dollar for dollar reduction, it doesn't matter whether you're making a $10,000 or $10 million, you're reducing it by whatever your tax credit. Whereas a tax deduction, it's more beneficial the higher your tax bracket. Obviously, somebody in a 35% tax bracket is going to save more money on a $500 tax deduction than somebody in the 10% tax bracket. Most credits are non-refundable. That means if you have a $500 tax credit, but you only owe $400 in taxes, you'll use your tax credit up and that's it. You don't get the extra $100 back. There are a few that allow you to do that, and we'll talk about some of those here in a little bit. And again, if your tax deductions reduce your taxable income below $0, you may generate an NOL, which can be carried over into future years. Credits are generally lost if not used, and deductions may be deferred into future years. One of the things we like to do is capitalizing instead of expensing. You know, maybe we can buy a piece of equipment or whatnot, and we don't need all of that write-off through like Section 179 or something this year, so we'll capitalize it and carry it forward into future years when we might need that tax deduction. So tax credits are generally greater than tax deduction because it's a dollar for dollar, but if you don't have a tax issue this year, then your tax deduction and its ability to move it forward into future years is better. So you just got to kind of play by ear. I mean, usually you're not trying to pick which do we want, a tax credit or tax deduction. Usually you qualify for them. And if you qualify for them, then you get them. It's not there's really, I can't think of anything that allows you to pick whether you want it as a deduction or a credit. It's just a matter of whether you qualify. Do you have kids? If yes, and are they under 17, then yes, you qualify for the child tax credit. And so you'll get it. There's no way to convert that to a tax deduction. I just want you to understand the difference between a tax deduction and a tax credit. So the first one we're going to talk about is the child tax credit. This is pretty straightforward. The child must be under 17, must be claimed as a dependent, and you get $2,000 per kid. Before 2018, it was just $1,000 per child, but after the 2018 tax bill, they raised it to $2,000, mainly because they did away with the exemptions. Remember, it used to matter how many people you were claiming on your tax return because you got a little bit of a tax deduction for every person you had on your tax return. Well, to mitigate the problems of erasing that, they've just doubled the child tax credit because these are most commonly the dependents on your tax return are your children. And so they just doubled it to $2,000 per child. They got to be under 17. This is a big kicker. I mean, we have 17-year-olds living in the house all the time, but you no longer get the $2,000 per child for them. And it can be partially refundable. So again, if your tax bill is only $500, you might get some of this extra money back. This $2,000 might come back to you as a refund, even though you didn't have that much tax bill. It starts to phase out at $400,000 for married filing jointly, $2,000 for everybody else. So that's pretty well, I think. It's on up there. So we don't see a lot of phase out of the child tax credit. And it's phased out $50 for every $1,000 over the threshold. So if you make $402,000, you're going to lose $100 of your $2,000, and so you'd only be eligible for $1,900 per child. Yeah, still doesn't make having a child profitable. You spend way more than $2,000 on having children, so don't let this be the motivator for having children. So if the child is over 17, and again, remember, we look at this on December 31st. So maybe your 16-year-old had a birthday this year, and now at December 31st, they're 17. You're not going to get the $2,000, but we might be able to qualify them as the other dependent credit. And what that is that's $500 tax credit for qualifying dependent, children 17 or older, and dependent parents, etc. People we're claiming on our tax return, we might be going to be able to qualify them for this other dependent credit. They must be claimed as a dependent, and this came about in 2018. Again, because we did away with the exemptions, people were kind of upset, so they gave a $500 tax credit. I don't know why they didn't just leave it alone. Everything was working fine for decades, and then all of a sudden they think, oh, let's give everybody tax credit instead of deductions. Yeah, so even though you might get $500 for having your parents living at your house, yeah, it doesn't make it worth having them live there. All right, so that's the child tax credit. The important thing to know is if your child is under 17 and you're claiming them on your tax return, then you're going to get $2,000. So this makes some divorce planning a little interesting because, you know, generally divorced parents will swap out every other year. And so depending on who your client is, depends on what years you want to tell them to claim it. Because when that child turns 17, it's a lot less beneficial to claim them on your tax return. So you want to make sure you get as many years that are under 16, or excuse me, under 17 on your tax return, and then the ex can have them in the years they turn 17 and whatnot. So anyway, that's the child tax credit. Coming up next, we're going to talk about the earned income credit, and this one is the crazy credit, but we'll talk about that next.